Trading, especially at the beginning, can be an experience that isolates you from other people. You need to invest a lot of time in order to improve, and in order to reach the peak of your abilities. Trading psychology is based on two main emotions that dominate the movement of the markets. These two emotions are greed and fear. Greed and fear are two emotions that come into play when you do not have a well-structured plan. The first step is to become aware of the fact that these emotions exist, and consequently work to minimize them, by making decisions that follow a logical and non-emotional strategy. Emotions don't have to overwhelm you. You must be in control of your emotions. Greed and fear can become the most dangerous enemies in this business, if you don't take control of them. Some methods used to reduce the impact of emotions when trading are breathing exercises, meditation, yoga, and sports. These methods should be chosen based on your personality and pleasures, so that they can really benefit you. Another efficient method to reduce the impact of emotions is to keep a trading journal about your trades, your attitude, and your emotions. Writing things down will help you to think logically and analyze your performance to understand what has to be improved. Your strategy should also be written in the most rational way possible, and must be followed strictly to generate continuous positive results. Discipline, perseverance, knowledge, and experience are very important factors. Discipline means following your trading strategy to the letter for every position that will be opened. If the conditions are not met, your discipline will be not opening any position. Discipline will lead to satisfying results over time. Consistency is simply the skill of staying disciplined every day. Knowledge and experience are essential in order to gain greater confidence when executing, managing, and exiting a trade. A risk management plan is essential to minimize emotions. By having a written strategy and a well-thought-out risk plan, the involvement of your emotions has already been minimized. It is very important to understand the psychology behind the Forex market. The market is not something physical, but it is simply the currency price, which moves according to the supply and demand of the investors. With that said, it becomes vital to open positions that only follow the direction of the current market trend. We as retail traders have no impact on the market, and we do not have to trade against it, but together with it. Central banks can see the positions of most investors and be aware of the global sentiment. Banks in some situations, especially during financial news releases, could make your life difficult by manipulating the price and trick you about the future direction of the market. We as retail traders must be aware of this and avoid entering the market during dangerous situations, such as during the release of high-impact news. The trading platforms have also been built very carefully. The simple fact that when a trade is in profit it is represented with the color green, and brings us confidence and hope, while a trade in loss is represented with the color red, and brings us fear and anger, even if the price movements are only of a few pips. Once you enter the trade, you must have confidence in the analysis and in your skills. We must not be glued to the computer and monitor the outcome of the trade. It is enough only to analyze the next candle closures on the chart, to decide if the trade should be closed earlier than expected. Even the chart with colored candles can play with your emotions. In fact, some traders, in order not to be fooled by the psychology of the colors of the candles, change the colors of them with blue, black, or white. Don't listen to useless headlines and news, because most of the time, they will just make you take the wrong decisions. One of the simplest concepts in trading, but of vital importance to understand, is that you should always buy at a low price and sell at a high price. This is associated with the foundations of technical analysis, when price is found at resistance levels and support levels, in hyperextended areas or after price corrections. Entering the market in these price zones represents the best timing to exploit market opportunities. To be successful in trading, you must learn to remove all kinds of emotions. This business is completely based on an economic result, but losing money or making money must not affect you emotionally. Always remember that in order to attract the maximum amount of economic success, you must have respect for money but at the same time be indifferent towards it. Money is fundamental in our life, and it is essential to understand that trading is a form of investment, and therefore the risk must always be proportional to the money you have. Experience will make you improve drastically, and will take you to the next level. Always learn from your mistakes by using honesty and logic, not emotions. One of the most common mistakes is that everyone wants to become a millionaire within a week, without following proper risk management, and risking 50% of their capital in the hope of doubling it. This is undoubtedly the fastest way to lose all of your capital in the shortest possible time. Investing with real money is very different from investing with virtual money, and this is where your weaknesses will emerge, and it will be essential to analyze yourself and understand how to manage your emotions. By starting to invest with mini lots and micro lots, you will begin to gain experience without risking a large amount of money. Each month closed in profit, you can increase a micro lot at a time, in the same way as you increase the weights in the gym using progressive overload. In the same way your body will adapt to handle higher weights, the same goes for your mind, which will adapt to handle bigger positions. Profit will be your measure in order to decide whether to increase your positions or not. There is no need to be in a hurry or to be afraid of missing an opportunity. The market is continually filled with opportunities. When you have a well-constructed plan, you shouldn't be in a hurry. It costs $0 to wait for the right trade, but it will cost you a lot more if you enter in the wrong trade for a lack of patience. Trading as a business is not identified as income, but as an investment. Great results can be achieved in the Forex market, but it is not a guaranteed income for every month. The best advice is to start to invest with a guaranteed monthly income, and create a growth plan with consistent deposits, as if you were a bank. In the Forex market, 90% of traders lose 90% of their capital in 90 days. The key is to survive and finding a winning system using low risk. By surviving 90 days, you will put yourself in the top 10% of the traders. The next step is to work on being profitable. In this market, traders lose money faster than in other financial markets. This is due to the incorrect use of leverage, overtrading, and by using a losing trading system. You must learn to invest logically and prudently. If you think that trading is just a bet with the market, you will never get concrete results in the long term. Once you have identified the strategy, or strategies, that are best adopted at the various moments of the market, the next step is to follow the rules with discipline and logic. A positive feedback cycle is a self-perpetuating pattern of behavior, in which the end result reinforces the initial act. When trades are opened constantly following the identified strategy, and generate profits with an adequate risk-reward, the results will lead to positive feedback cycles. Success attracts greater success, and this will generate greater confidence when trading. Stick to your plan, and focus on following your trading strategy at all times. We must not be afraid of small losses, but we must constantly learn from them, in order to improve and understand which market conditions to avoid, focusing exclusively on long-term results. Too much enthusiasm can bring to irrational exuberance, that will lead to negative results. Overconfidence and overestimation of your abilities will bring you to bad decisions, such as risking more capital than usual, and entering trades when the setup is not as it should be. When executing trades, be confident and follow strictly your risk management plan without involving emotions. Always look at trades from different angles, and filter opportunities to leverage the best ones. To continue experiencing positive feedback cycles, you must have a rational trading plan, and you must continuously measure your results over time. A negative feedback cycle is a self-perpetuating downward spiral, where some initial bad event is being compounded, and made worse by the behavior of the trader. Panic, fear, overconfidence, and greed are emotions that drive this negative cycle. The main reason of why a trader enters in a negative feedback cycle is a lack of emotional management that brings the trader to focus on money, instead of focusing on learning and improving. The lack of a correct risk management is the main reason of why so many traders fail. These traders are solely focused on the short term, and they don't understand that trading requires patience, and that there is no need to be in a hurry to make profit. Another important factor is not having a rational backtested system. Before entering a positive feedback cycle, you need to first have a positive history of profitable results that confirm your trading system. You can't expect to be profitable in the long term if your strategy is weak and does not adapt to the market. Negative feedback cycles will continue to be experienced if the trader does not adapt to the changing market and does not put in work to improve its trading system and emotional management.